Hey, what's going on, guys? Welcome back to my channel. This is Blood Phantom 81. In this video, I'm going to be doing my stock market recap and update and predictions video, although it'll be less about predictions and more about the recap and the update. So account's currently at 322. I think it's recovering a little bit slower because most of my money went into growth, especially as the market was pulling back. And so as growth continues to expand, which hopefully it does, then it's quite possible, honestly, that 400K is right around the corner for this summer. If growth not only recovers, but maybe even exceeds previous all-time highs. I don't know, we'll see. Let's jump right into the charts to see what I'm talking about. All right, so this is the NASDAQ. This is the QQQ ETF. So basically what I was talking about last week was this inverse head and shoulders that I thought would form. And just as a quick recap, this was my last week's video when I talked about what that inverse head and shoulders could look like once it became more symmetrical. I talked about the 0.5 and 0.318 retracement as an area that could act as support. We ended up retracing a little bit deeper than that. As you guys can see, we actually hit the 0.618 retracement, and that's actually pretty significant, and I'll explain why in a second, why that's important or notable. But yeah, basically 0.618, and then afterwards it's been off to the races. The awesome thing about this is obviously we're now breaking out of this inverse head and shoulders pattern. I mean, there is some overhead resistance right here, which, we may have to pull back a little bit before we break that. I'm not sure. Point is, this is looking pretty strong, so I'm not really concerned about the short term. I think this is like a huge development. And the other thing is that if we take this out and we zoom out for a bit, let's take it to a daily time frame. It's pretty obvious that we've also broken out of this support range. The reason why it's obvious is because think about all the touches that we had against this this area of resistance. And once we actually did break out above it, these are some pretty big moves, right? It's a pretty big gap up on Thursday, yesterday. And even before that, that was a pretty big move, right? I think there was like 1.5% days, respectively. And so, yeah, it's quite possible that this sort of correction that we had, which was about maybe 10% in the NASDAQ, maybe 11, close to 12%, could be over. That's sort of what I hinted at in my last video. And let's jump right into why this sort of correction was important. So for those of you that know or care about Elliott wave theory, it's quite possible that this is the start of a new impulsive wave. So because we did retrace to the 0.618, which is a pretty common retracement for wave 2, then as far as the wave 3 would go, a very conservative estimate would be a 1-to-1 relationship between wave 1 and wave 3. And I realize this is kind of getting out of hand. I'm just jumping right into Elliott wave theory. Basically, what I'm trying to say is that if stocks move on impulses and waves, then the next wave might take us at or near all-time highs before seeing a smaller correction and then heading up a little bit higher. Point is, I think this is pretty bullish. And one thing I find extremely interesting too is that if we take a look at a monthly time frame, which is a little bit longer on the S&P 500, a picture says 1,000 words, and this is absolutely no exception. So if we take a look at the sort of consolidation ranges during this past bull run, which, by the way, the reason why I think we've been so bullish lately is because this right here is actually a multi-decade consolidation range, which is the 2000 crash and the 2008 crash, and we didn't actually break above this until about 2013. And so 2013, we finally broke out of this obvious area of resistance, and then it was sort of off to the races. Obviously had some pullback, but basically what I want to draw the attention to is this right here. And so although this area of resistance is a little bit steeper than the previous ones, I don't even have to say it, right? It's sort of implied what this means, what this could mean. I'm not saying, we're going to have a multi-month sort of melt-up rally like we experienced in 2017 or 2013. But I am saying the potential is very, very clear, right? And what I mean by that is if we think about like ARK Invest, for example, ARK Invest always has like a bull case, a base case, and a bear case. And the way that they come to those conclusions, in my opinion, is obviously I don't work there. I've never talked to Kathy before, but the way I think about it is they probably assign probabilities to each of the potential outcomes, and then they do like an expected value of each of the outcomes for the three categories. Um, Basically, what this means is that the bull case is very much in play. The bull case is a melt up heading into summer, right? And so, if I wanted to come up with the base case, then I might, weight the downside outcomes a little bit more. And that's how I would come up with like a base case, and like a bear case would be obviously we break below this. And I don't think we have to talk about that until that happens, right? So yeah, that's the thing. And I think the other thing that's on everybody's mind with this correction is, when is the next big correction going to happen, right? It's only been about a year since we had this absolutely crazy, catastrophic correction where it seemed like the sky was falling, and just as quickly the market recovered. And so everybody's sort of wondering when the next 20% correction is, when the next 30% correction is. Has definitely been on everybody's minds. That favors the buyers, because that sort of uncertainty and fear sort of allows folks to FOMO buy into the market once it actually starts to rally. And each of these corrections, however small they are, creates fear, in my opinion, right? Because we're always thinking, okay, this is going to be the big one, this is going to be the big one, this is going to be, because this is so etched into our minds, right? And so that's part of the reason why really large corrections can lead to some really violent recoveries, because of the kind of fear that it creates. And we want lack of market participation. We need we need bears in order to head higher, as kind of counterintuitive as that sounds. I think I wanted to make one more point, but before that, I'm actually really excited to show something to you guys, which is I created my own indicator on TradingView. And so, yeah, this is 100% Blood Phantom 81, a product. And so this is basically the source code for this indicator. Let me know if you guys want the source code. I really don't mind sharing. But basically what it is, I've always talked about this, which is how far away we are from major moving averages, like the 200-day, for example. And I've always kind of speculated, like, okay, we're obviously overextended because we're this far above the 200-day moving average. But I never really like standardized it until now, or until like the past couple weeks. And so it's my own indicator. And it's actually pretty cool. Like, you can put in your own parameters, which is something I set. So if I cared about the 50-day moving average, I would just put the 50. So this is the 200-day moving average. And yeah, it's actually really, really cool. I've learned so much just by looking at this. And so you guys know that, like, I'm not a big fan of traditional valuation metrics as far as determining if this market is extended or not. I'm much more concerned with sentiments, things like euphoria and fear. Because I think like parabolic moves are obviously a sign of high optimism. And so this gives us a way to quantify, historically, whether we're overextended or not. And so this is a lot more systematic, I think, than any other type of valuation metric. And one lesson I want to give here is actually kind of how to think about it, right? Because I mean, I don't want to just share like a hint or a preview and then not like talk through it. So basically, the way I think about it is I created like three sort of areas of resistance, and sort of three areas of, I guess, support. Or that's two areas, but I mean, it's not really as relevant as the overbought signals. So I always talk about, if the market's overextended, then that would be a good time to consider to take profits, right? And so now we want to systemize, okay, what does it mean for the market to be overextended? So if we take a look here, let me see if I can make this a little bit bigger. So if we take a look here, it's obvious, like, okay, this went way above, these areas of resistance. Like, what gives? This indicator is broken. As it turns out, let's actually take a look at the NASDAQ composite, which has a little bit more history. So as it turns out, once we come out of extremely overbought oversold territory, like these really nasty corrections, another one would be the 2009 correction. It's totally possible to reach overbought signals as a result. And the fact is that's actually happened each time we've had a really, really nasty correction. So 2000, 2008, 2009, and then now March 2020, we're coming off the initial wave off of an extremely oversold reaction, right? So big crash, big recovery, if I could put it in a few words, like Kevin from The Office. So, so if we have a big recovery, it's totally normal to have really overbought reactions, right? And so we have to still give the benefit of the doubt to the buyers, even when we get overbought. If we take a look at this 2009 case, for example, we went from oversold to overbought, and so it's obviously near the top of this reading. And basically, what we see here is that there's some kind of mean reversion after this first initial wave of euphoria. And so two things that I want to highlight here is that, number one, even though it's getting closer to reverting to the mean, which is the 200-day moving average, we're still making higher highs. And so in order to revert to the mean, we don't necessarily have to go down, but stocks can actually consolidate through time as well. And so relative to the 200-day moving average, the price was actually slowing down, but we can still make higher highs, right? And so, yeah, little by little, it starts to revert to the mean. And so once we do get that mean reversion, then sentiment gets reset. Then we can expect this to be more of a traditional signal where I have this sort of second layer, which is, this percentage above the 200-day moving average. This becomes the new overbought signal going forward. And so obviously this is an overbought signal right here. This is an overbought signal right here. And then we don't actually hit it again until January 2018, which is here, right? Because this is the second layer. And we actually hit it here back before the COVID crash. And so one thing I really want to emphasize here is error, because obviously there's going to be some error, right? There's two types of errors. There's false positives and false negatives. And so a false positive would mean that this says that we're going to crash and we don't crash. That's a false positive. That's a way, way, way worse error than the opposite, which is saying we're not going to crash, but we do crash. This is trying to come up with the positive, not necessarily capture all the, or reduce the false negatives as much as possible. So basically, this is optimized to say when there's going to be a crash, I'm pretty certain there's going to be a crash, right? Because generally the trend of the overall market tends to be up, and so you always want to, if you have to pick one type of error, which is you either hold too long or you sell too early, you would always want to go with you hold on for too long, because think about the secular bull market that we're in, right? And so as of now, we have to give the benefit of the doubt to the buyers. And so I'm not really concerned with saying, okay, well, the market crashed, but this didn't actually get overbought, so like what gives? That's not what my concern is with this particular indicator, because this is specifically for these sort of parabolic, more obvious type of corrections, right? And so we can clearly see here that before the COVID crash, January 2018, and then even some of the corrections back here, as I called, that actually led to a pretty good time to start consider taking profits. And the other point I want to make here is that this isn't an all or nothing thing, right? If we start to become a little bit overextended, it's okay to start taking a little bit of profits. You don't have to be all in or all out. I think we shouldn't start thinking in binary. And so the question now is, where exactly are we? Like, are we still in this first wave of euphoria? And we have to sort of take it with a grain of salt, meaning that once we actually do revert to the mean, then we start using a more traditional overbought signal. And in my opinion, I think we still are in that first wave of euphoria. I don't think the mean reversion has happened yet or will happen. I think the market's on its way to making all-time highs, if I'm being completely honest. And so, yeah, I think there might be just one more small wave before we do see something like a 15% correction, because I think right now we saw like an 11% correction. And yeah, I think one thing else to keep in mind is that, like, let's say here, right, 2009, there wasn't really like this massive 40%er that allowed us to rebuy shares, right? It's actually getting really difficult to get into good positions long term, because the market just kept on going up, right? Because that's what happens when you're in a secular bull market, as I showed with the S&P 500. You might not have those opportunities. And that's why this past month was such a gift, because we think about all the stocks that just corrected significantly. Let's go ahead and take a look at skills. Actually, before we do that, check this out. This is actually really cool. So this is a trend line that we finally got above after this March crash. And we actually retested it a couple times, and now we're breaking out higher. And we had something similar here, actually, um, leading up to this super euphoric run. And so this is obviously an area of resistance that we ended up using as support, and then it led to this super euphoric run. And so, we could be seeing something similar here. This is actually how this secular bull market ended in 2000. It was actually because of a parabolic top, and so it's quite possible we might be putting one of those in as well. But what thing? Oh yeah, what was I gonna say? Oh yeah, so skills, right? We think about high quality. Well, I don't know. That's a little bit subjective. Some people might not see this as high quality, but I think this is a pretty cool company. Fundamentally speaking, actually, they've never seen a decrease in paying monthly active users. Because obviously this is not a social media website, so monthly active users is not what Skills Inc. cares about. They care about paying monthly active users, and so that's actually seen an increase every single quarter. And this is sort of like an entertainment and gaming and like gambling platform all in one. And I mean, think about the correction that this thing saw. So we went from $45 a share all the way to $59 a share. I'm sorry, we dropped 59% all the way to $18 per share. And so anytime you see like practically a 60% decrease, which was peak to low, I mean that's obviously like something to pay attention to, right? Especially if we're talking about really good companies. And yeah, I think there's a couple other like pretty decent SPACs I would say that got hit. Um, Lucid Motors, aka CCIV, Churchill Capital, also saw a pretty deep correction at I think like 66%. Now, I'm not necessarily pouring money into these first before I pour into something that's a little bit higher quality. Let's say like Square, for example. Square and PayPal are both definitely on my list. And so, Square is such a strong company. It only, and only, take that with a grain of salt, only saw about a 30% correction from peak to high. But think about that for a second. We were just in this period, assuming that the market continues higher, we were just in this period where a big chunk of the market, like let's say the value stocks, the stocks in the Dow 30, actually saw pretty higher highs, right? Let's take a look at what the Dow Jones looks like. So this, consistently made higher highs, and the Nasdaq, dropped about 11%. But the Nasdaq doesn't even tell the full story because the rest of these high growth stocks got destroyed. What's one of my favorites 3D printing stocks right now? It's actually Stratasys. And Stratasys got wrecked, right? This is a 62% drop. And we think about where, what that is relative to where it's been historically. And, it's a retest of the 200 week moving average. A 60% drop in just like a couple of weeks, really. Well, maybe a little bit longer than that, but still, how can we not get excited about these opportunities? And, it's not that often that we see such a divergence between value and growth. And yeah, it's just like such a great opportunity recently. And so I've been pouring as much money as I can into these growth stocks, even slow down on the dividend stocks actually. And so once tech and growth recovers, because it's not just a tech thing, it's a growth thing. So once and hopefully soon growth actually recovers, I'll be able to take some off the table and then start funding money into my dividend growth portfolio a little bit more. But yeah, that's kind of where my mind's been at lately. Let's wrap up by talking about the NASDAQ. So yeah, so things are looking pretty decent for the NASDAQ. I'm assuming that we are going to make higher highs in the short term. At least obviously that's my hope. And then yeah, we'll take it one day at a time. I'm not going to make any crazy predictions in this video other than saying I think we're going to get close to all-time highs or at all-time highs in the not so distant future. So that's the only prediction that I'm making, and we'll take it day by day after that. Yeah, last thing I'll say, as far as market performance goes, I'm not extremely happy with how my accounts have been. I mean, I did buy a lot of growth stocks, but yeah, I need to, work on that a little bit more, I think. And yeah, try to take advantage of these market opportunities as much as possible. But I think like once growth picks up, my account should pick up, and it's quite possible that we have a summer melt up. Um, April is actually a historically good month for the stock market, and then the way things are setting up right now with this correction looking like it's coming to a close, and April just starting, it's possible we have a good April and May. At least that's my hope. So yeah, we'll see how this goes. Thank you guys for watching this video, and yeah, I'll see you guys in the next video.